Welcome to Certified Credit's Talk Data to Me podcast, where our FCRA certified experts help you tackle the latest regulations, emerging trends, and unique challenges of the mortgage industry with an intuitive, people-first approach. And of course, data, because your business is built on more than just a score. Visit certifiedcredit.com for more information. Certified Credit helps you hone your best practices from lead generation to post-closing QC and everything in between. This is Elizabeth Langbarton of Certified Credit's Talk Data to Me podcast. And with me today is a man who needs no introductions, Mr. Rob Chrisman. How you doing, Rob?
I'm doing well. Thank you for having me on.
Thank you for joining. I am so excited to talk to you. I always start my day with the Chrisman Commentary, which I'm sure so many people in our industry do. So let's just do a quick background for anyone who's not really familiar with you as an individual. Can you tell us a little bit about yourself?
Sure. I was, I'm just a capital markets guy and a product of the California education system, and went into capital markets after getting an MBA from UC Berkeley, and have been there ever since, really, although in 2008, I stopped doing the day-to-day capital markets to focus on my dad, because my mom had just died, and see more of my kids and so on, but kept sending out this little commentary, and the commentary has grown over the years, and I really enjoy doing it. And I like to think that I'm able to help a few folks out there every year or every month or every week or every day, at least with a laugh, because I put a joke at the end of the commentary. But it definitely keeps me involved in the industry. And I tell people, when I stop liking doing it, I'll stop doing it. But so far, so good.
So far, going strong. I mean, the Chrisman Commentary, my favorite part is at the beginning, when you just throw in something about whatever's happening in the news, or your cat Myrtle. And we'll get to that later. I do want to talk to you about Myrtle. I'm an animal lover, so I'd like to hear a little bit about her. But what kind of inspired that commentary? I know you said you took a step back from the capital markets and we're focusing on family, but what inspired you to stay in that focus?
It had come about, excuse me, because working on a trading desk, you have to give clients information about why the market is moving and what's going on with personal income and consumption and unemployment and so forth. And then when email came along, it became easier to send out information via email. And then some clients wanted a little more information and a little more information. And so it kind of grew from just talking about what interest rates were doing to talking about what investors were up to, that, what was going on with investors, and then just general news and how it might impact the market. And what I found out over the years is that the information, if you're looking for a job, it's a great place to go. If you're looking for a new LOS or sub-servicer or consulting, whatever it is, it's a good place to go. If you want to know what investors are doing, it's a good place to go. But a spoonful of sugar helps the medicine go down. And so I always found that on a trading desk, jokes were good. Usually they were unrepeatable to various people, but jokes were good. And then, man does not live by bread alone. And so I found that putting in little tidbits of other information that I judge, I use some editorial, preferences there, but information that I find interesting, or little quips that I find interesting, and especially if they tie into the financial markets, even better. But I usually throw those in the first paragraph. But a lot of people read the commentary who aren't even in our business or have retired from our business. I tell them, look, I appreciate you subscribing. If you want to read something, read the opening paragraph and read the joke. The other things you might not care about. But like I said, if you're looking for a job or a new, system to do something, then, definitely there's more information for you.
Yeah. And that's so important right now, thinking about the job market. Right now, we're in a very tough space in the mortgage industry, as you are well aware. But a lot of individuals look to that job section. That's like second thing that on the commentary for opportunities. Because it is hard right now. I mean, we've had rolling layoffs across the industry since summer. So it's awesome that that's a resource that's available. So going back to that more personal touch, your cat Myrtle. I love when you bring Myrtle in because I think we can all kind of relate to that, having your pet around, especially in the work from home environment. I'm sure my dogs, if they could talk, could tell you how the mortgage origination process happens. But Myrtle makes an appearance very often. And so when did you start bringing Myrtle into the fold? How did you get inspired to do that?
Well, first of all, Myrtle's real. And when I travel somewhere, I'm at a conference, oftentimes someone will come up and they'll challenge me and say, show me a picture of Myrtle. And I've got one on my phone. I've got one or two on my phone. She's large and in charge, and she the whole, I'm not going to bore you with the story of how Myrtle got her name, sometime in person, but it is an interesting story. And, animals are good. I had a dog, Sweetie, who passed away in July of 2015. I had an obituary in my commentary, which people still talk about. These animals get into your lives, as you know, and we kind of know that we tend not to make it out of life alive. But these animals don't know what is in the future, and they look at humans as being their, caregivers. And there's this bond that is forged. And some people are cat people and other people are not cat people. And same with dog people. Got a dog as well around here somewhere. But Myrtle, just because of her name, I figured let's throw her into the mix a little bit. Initially, she started commenting. She started, having thoughts about the CFPB. So this was back, 2012, 2014, I think, when she started to gain a little traction. And she's large and in charge. She's 10 or 11 years old, and she's still got
a lot of life left in her.
Yeah,
we're going to be hearing her thoughts on the market.
Yeah. So that's the story about Myrtle, and people view her. It's like I won't say she's an alter ego, but she is able to perhaps allow me to put thoughts out there and suggestions that I might not, but maybe Myrtle's thinking them. So blame Myrtle, kind of thing. So
kind of that personification. It allows you to say what we're all thinking without saying it. Right. I love that. So, speaking a little bit more on the commentary side, and going into some of the items that you're including in the commentary, for the past several months, you've been including those economic lessons, which I noticed were kind of transitioning, probably about June or July of this year. You start transitioning into more of lessons rather than just the commentary on the markets. And that's a great source for professionals who maybe are not as familiar with the secondary market, are not as familiar with what's happening with inflation, the bull market, the bear market. So what areas should industry professionals be looking at to keep pulse of the market? Obviously this commentary portion, but where are you getting the inspiration for these lessons?
Well, it used to be much easier to put in theoretical information, like why, when bond prices go up, why do rates go down, or what is a basis point, or how the mortgage-backed security market works, or why it's liquid, or how things work. Right. But as the news magnified, as more news came out every day, I became less able to do that because I was busy talking about what certain investors were doing rather than necessarily why they might be doing it. Lately, the news has died down a little bit. And when it does, I'm able to put, information in there to help people on a more theoretical basis. I like doing that because it gives people a foundation upon which to build some knowledge, because, they may not, I can throw stuff all day long at you in terms of, Citizens is doing that and Chase is doing this and Wells Fargo, yada, yada, yada. But to have that information about how our market works is very important, because if you think about a typical mortgage lender, whether it's a bank or a credit union or an independent mortgage bank, there are a lot of people involved in manufacturing loans, and they may not know what happens farther down the manufacturing line,
Mm-hmm.
or once the loan funds, they say goodbye to it. But there's a whole different thing that happens with regard to servicing and investor reporting and foreclosures and delinquencies and what happens to that loan. And so I think it's important for people to have kind of a more holistic view of what we do, rather than just sit there in their silo and underwrite loans all day or process loans all day. Loan officers themselves they face this every day because they are in effect running their own little business. They are dealing with borrowers. They're dealing with, behavioral economics. They're dealing with psychology. They're dealing with that. But on a bigger scale, they're dealing with interest rate movements and how the housing market and the global economy. And so they're trying to run their business with an eye on all of these things. And so it's not easy to do. No. So I try to help people see that there are other parts of our industry that they might want to be aware of.
Yeah. And that's really interesting too, from a perspective of someone who's newer to the mortgage industry, looking at the different areas. So, we focus on that origination portion. We're not really dabbling into the secondary markets, and knowing what's happening helps you understand the life of a lender, helps you understand those servicers, helps you really grasp at what does this look like as a holistic picture? How is the interest rate impacting not only your loan officers and your borrowers, but further down the line? And you talked a little bit about the rates that are happening right now and those rate changes. And right now we're in this very volatile market. I mean, we've settled for right now. So looking at that area, officials have signaled that they plan to keep raising rates to between 5 and 5.5% throughout the rest of this year, and keeping it kind of there. Do you foresee that being the case? Should we expect an increase? I know that they're saying they're not going to waiver. What do you expect, looking at your expertise?
Well, you find out that everybody has a plan until the first shot is fired, kind of thing. And the Federal Reserve has to be able to lend stability to the market and say things that are a little bit predictive, or in terms of forecasting, okay, here's what we think. But we receive economic information every week, and the economic information that we receive may change the Federal Reserve's mind. So they have to show stability, but they have to show flexibility at the same time to adapt to the current environment. Right. We started 2020 with everyone thinking, all the experts thinking, oh, rates are going to creep higher, and business will be as usual, and the housing market's going to do whatever. Nobody, of course, saw the pandemic hit, the impact of that on the housing market, the impact of that on the rate environment, the severity of what was going on there. And so the whole industry, the whole nation, the whole world had to change based on that. So all the predictions that were in the early part of 2020, flew out the window. They were worthless. 2022 started, and people thought rates would kind of creep up, and they thought this, and inflation was starting to be a problem. And then all of a sudden, Russia invades Ukraine. So we had to be able to adapt to those things. Now we enter 2023, and we start to move through 2023. Right. Nobody's predicting another pandemic. Nobody's predicting another, invasion. Right. There are signs out there that China might do something. I mean, there's always kind of things going on out there in the world. Nobody has a crystal ball, though. And so the ability for interest rates to change based on world news and US news is very, very important. Right now, as we're taping this, rates have been relatively stable. They've been creeping down a little bit here as we begin 2023. It's nice to see. People are talking about a recession, but people have been talking about a recession for months and months and months and months and months. And the employment picture is good. Personal income and consumption are decent. Right. The housing market, you see these headlines about housing crashing. I don't see housing crashing. I see, we don't have the same ability, I think, to have housing appreciate 20% a year for the last couple of years. We have to come off that pace to be healthy. So I see appreciation slowing down, which is fine. but in certain markets, it's still very, very solid.
Mhm.
At the higher end of the price levels, San Francisco or Manhattan, yeah, there's some weakness, but
Yeah.
in places like Yuma, Arizona, or Omaha, Nebraska, I think the
Mhm.
market is still pretty good. And so we're dealing with these things. So right now, actually, the inflation data that we've been receiving has been good. It's showing that the Federal Reserve is having an impact, and it's showing that we're in an okay place. So rates are
Right.
where they are, and I think people will become accustomed to interest rates where they are and
Mhm.
carry on business.
Right.
Nobody's out there basing the future of their company based on somebody's interest rate predictions. At least I hope not.
Right.
And so they tend to be more focused on service and programs and let
Mhm.
rates do what they may. And right now rates are pretty stable.
Yeah, I think that's really interesting, talking in there about the markets that are still booming. I have friends in real estate here in Pittsburgh, Pennsylvania, and they said January was one of the busiest Januaries they've ever seen. I mean, it's January 18th, and they're already making numbers double past what they usually do, because the market's hot right now. That 6.5-ish% that we're at right now, depending on what loan product you're using, isn't scaring people off anymore.
Yeah.
People have to move. I mean, if you need to find a house, you need to find a house.
Yeah,
So,
you get tired of the landlord raising rent, or you
mhm.
want a roof over your head and you don't want to sleep in your parents' basement anymore, or you're going to
Yeah.
get married, or you're going to have kids. I mean, there's always demands for housing, and with so many millions of Americans being 25 to 35 or 40,
Mhm.
and many millions still don't own a home, and they may
Right.
not want to own a home, but a lot do. And so
Right.
at the lower end of the housing market or the starter home, definitely things fly off the shelf.
Right. And I think looking at that too, we're having a lot of conversations throughout the industry about minority borrowers and those in underserved communities, and how right now is a really good time for them to get into the market. We just had a conversation with several experts about that. And when we talk about this market isn't going to last forever. Um, but something I did want to look to is more than 250,000 borrowers, or 8% of borrowers in 2022, owe more on their home now than it's worth. So that's roughly 1 million have less than 10% equity. So this is adding to that challenge that we were just talking about. The appreciation's not nearly where it was a year ago, 2 years ago. And housing prices have seen, almost zero appreciation over the past several months. So how do you see that impacting future markets, or that looming recession that we keep talking about?
There are always there are always headlines, and
Mm-hmm.
I'm always skeptical about headlines. For example, if I have two dogs
Mm-hmm.
and I get another dog, the headline would be Rob Chrisman, increases dog population by 30, by 50%,
Yeah.
going from 2 to 3, up 50%. Oh my gosh, 50%
Right.
dog appreciation. Um, when you look at the housing market, it's important for people to remember that we are dealing with the homing market
Right.
rather than the housing market. We can look at the statistics all we want, but if you have a new family and they are in a house, which becomes a
Mm-hmm.
home, not that it doesn't matter what happens to the price of that home while they're there. They know
Mm-hmm.
that they're in a good school district. They know they have a good commute to work, or they have a little
Mm-hmm.
home office they can work from there. They know they like their neighbors, their potlucks, once a month in the neighborhood. The stores are nearby, the banks are near, whatever. They're in it. Their parents live nearby. They're at
Mm-hmm.
the end of a cul-de-sac, whatever it is. They
Right.
aren't sitting there typically saying, oh my gosh, last month our house value went down 0.5% or it went up a
Mm-hmm.
0.5%. They know that they like where they live and that's their home. And
Right.
so I think that fact is forgotten a lot in the mainstream press. And yeah, you see nationwide trends about different markets doing different things, and the high end and the low end in different
Mm-hmm.
regions, the West versus the Southeast versus the Northwest, whatever it
Mm-hmm.
might be. There's a lot of trends that the press likes to report on, but through it all, when you get down into the weeds, you're dealing with people and with families,
Right.
and they may not care so much about that. So you have a situation where there's a lot of numbers out there, a lot of housing gauges, a lot of almost instantaneous housing gauges by, companies like Zillow or Redfin and so forth, which may or may not be indicative of the marketplace. But it comes back to people need a place to live. And the housing, I don't think we are anywhere near a position where we were in 2008, 2009.
I was just going to ask you about how you thought this compared to that time period.
Right. Yeah. Back then, the loan programs that were being offered and the investors buying pools of loans with those loan programs.
Right.
I mean, it was not a great position to be in, stated this, stated income, stated asset, all kinds of things going on.
Right.
Now, when you talk to underwriters or capital markets people or investors and so forth, they will argue that the loans that have been produced over the last several years are to some of the most creditworthy borrowers ever in the history of mortgage lending. Not only that, but anybody who bought a house prior to a couple of years ago has seen a tremendous amount of appreciation. So you have creditworthy borrowers in a house that has equity.
Right.
That's not going anywhere. That's still out there. And so no one's asking me about a tidal wave of foreclosures like they were, 15 years ago.
Right.
They are looking at this saying, wow, the housing market is pretty stable. And there's always be little chinks in the armor in terms of, oh my gosh, what about this? And what about that? Foreclosures went from, 100 to 200 nationwide. I'm just making that number up,
right.
But you have to remember, you have to keep things in context about how many housing units there are and what are the numbers doing in terms of, the Chrisman dog population went from 2 to 3. So it's up 50%. Well, that's 50%. Wow. Well, it only went from 2 to 3.
Right.
You have to look beyond just the percentages and look at what's going on under the numbers, as it were. So there's been talk about a recession for months and months. The housing market, is going to do what it's due. The employment picture looks pretty strong right now. People have jobs. Unemployment is 3.5 or 3 something.
Yeah, 3.5%.
It's very, very low. And so people are out there, they have jobs, there's stability, their spending is slowing down a little bit because when we came out of the pandemic, a lot of people wanted to go to Disneyland and so on and go to Olive Garden.
Yeah.
That's dying down a little bit, especially in the middle of the winter. I'm not going to, go to Disneyland necessarily, and I'm kind of, I bought all the clothes I wanted to buy and so forth and so on.
See, I would go to Disneyland in the winter because where I'm at, it snows. But
true. Or Disney World, right? Yeah. So the consumer is going to do what the consumer is going to do, and the housing market's going to do whatever. Right. But any tales of doom and gloom, any headline grabbing kind of clickbait kind of stuff, you have to look beyond the headlines sometimes. Yeah.
Well, and something you're talking about in there, we were talking about 2008 compared to now. And it makes me think of, I'm a little leery of the 2-1 buy downs, because thinking about, you go in at a certain price and in 2 years, that's going to be a very different price that you're paying for your home every month. Your mortgage is going to be very different. Do you see that having any impact when it comes to the housing market, the foreclosure market?
Did you say you have a 2-1 buy down?
I do not.
Oh, okay.
I hear about them and it makes me nervous.
Okay. I don't, the buy down program has been I got in the business in the mid 80s and we had a buy down program. Okay. And it didn't result in any kind of catastrophe. Yes, a certain portion of the business out there that's being funded is buy down product, and how that works is important for loan officers and borrowers to understand as well as investors. And I think the understanding is very good. The buy down allows a certain portion of the population to get into homes and be able to afford them that otherwise they may not have been able to. I don't see it causing a catastrophe, or, I'm sure some borrower somewhere will be strained at some point, and they may call the local newspaper and say, we can't afford our payments anymore. We were sold this buy down loan. We didn't know what it was. And that'll once again grab the headlines. But I'd say it's a valuable product. Certainly the Consumer Finance Protection Bureau hasn't said we can't offer it as an industry. Right. It's been a tool that builders have offered for many, many years. So it's in the arsenal of what lenders can offer. And so I don't necessarily think it's a bad thing as long as everybody understands what's going to happen, when, 2-1 or 1-0 or whatever the buy down,
Right.
whatever that term is, I think it's important to understand. And it's also important for borrowers to know that, hey, keep your job,
Yeah.
and put aside some money perhaps to be able to deal with the payment. Maybe the payment goes up $50 a month or $80 a month or whatever it might be. I don't think, generally speaking, depending on the loan amount, it's a huge jump when any kind of buy down program adjusts. It's hopefully most borrowers find it easy to digest.
Okay. I think that's interesting too. You talk about you have to educate the consumer. I think we're seeing across the board, there is an inherent distrust when it comes to lending. I know Kristen Meserly talks a lot about with the younger generations having that inherent distrust in the system. And so with programs like a 2-1 buy down, I obviously fall into that younger generation, and I'm leery of it because while I understand the concept being in the industry, it's still one of those things where it's like, there's that inherent distrust. So it's interesting to talk about that educational aspect and how, as mortgage professionals, it's our jobs to educate the general population, and things like, taking a lesson from the Chrisman Commentary and sharing that lesson with your borrower and saying, hey, here's an industry expert who says, this is what's happening in the market. This is how this is going to impact you, and sharing that information. So as we're looking to kind of wrapping up our time together, I did want to ask you, we don't know what's going to happen. We don't have a crystal ball, but what advice do you have for lenders about weathering the current market and continuing to prosper in 2023?
It's important when I talk to loan officers, successful loan officers who have seen their volumes plunge, they view it as part of the cycle. And hopefully they saved some money during 2020 and 2021, arguably the best 2 years we'll ever see in the industry. So they've got some savings, and they know that things weren't going to continue just like they were in those prior 2 years. So they've seen the volume drop off dramatically, margins are down, revenues down. But I think, it's part of the business cycle. A lot of people or a certain portion of our industry is aging out. So they're leaving. Companies are consolidating, costs are being cut. And so many people view this as kind of a, wintertime trimming of fruit trees. You do that in the wintertime, and in the spring, they do even better. And so I think the companies that can last and make the changes necessary will succeed as 2023 goes on.
It sounds like, listening to you, listening to other industry experts, there is that glimmer of hope. Like, we will get out of this. We have to. There's how people need houses. One of the easiest ways for someone to get into a home is to have a mortgage. We all don't have, $100,000 laying around or more, $300,000 laying around to buy a starter home. So it's a barrier. That's that barrier to entry. And people need to have a home. I mean, so I think it's really promising that, you're hopeful about the future. Other industry experts are hopeful about the future, and we'll see what 2023 brings. But thank you so much for joining me. This was wonderful getting to talk to you, getting to know you a little bit, hearing about your life and Myrtle.
And all right, Elizabeth, thank you.
All right. Thank you so much, Rob. I really appreciate it. Have a great day.
You too. Bye.
Bye-bye.
Thanks for listening to Certified Credit's Talk Data to Me podcast. With over 35 years of industry experience, Certified Credit is your multifaceted mortgage solutions partner. Learn how our commitment to passionate service, innovative products, and superior technology create a more profitable and efficient lending environment for our clients at certifiedcredit.com. Certified Credit, more than just a score.